What's going on, YouTube, and welcome back to Tech Conversations. I am your host, Guillermo. It is June 27th. Hope you're all having a great weekend so far. Let me know in the comment section below if you think tomorrow will be a red day or a green day in the stock market. Now, in today's video, I want to talk about a very interesting strategy that's very cheap and very simple to use. And because it's so simple, I think it's very often overlooked. So I'll show you guys how it works and show you guys an example of this strategy. Now, before I get into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Let's start off by talking about what our goal is from this with this strategy, and of course, what the ideal stocks to use are as well. So our goal with this strategy will be to benefit from bearish movement in the underlying stock with limited risk. So again, two things there. Number one, I always stick with strategies that have limited risk. Stay away from strategies that expose you to unlimited risk. Number two, it's always important to have strategies for any market condition, a bullish market, bearish market, neutral market. And I do think this is one of my top bearish movement strategies. Now, the appropriate market forecast, then, since we do want the stock to drop in price, we do want a modestly bearish forecast. The stock's not going to need to drop a ton. And actually, if the stock moves sideways, most of the time you'll still make money. But ultimately, modestly bearish forecast, which means the ideal stocks you want to use then will be stocks that you believe will drop in price by the expiration date that you choose. And so ultimately it should be about short-term bearish. And so what I'm going to do here, I'm going to use just a random stock. I'm going to use ticker symbol CCL, which is Carnival. This is going to be just a random example here, so don't copy this exact same trade, but just so you guys can kind of see what it would kind of look like and how you would set this up. So here we are on Carnival, and again, let's pretend that I'm short-term bearish on Carnival. So since I believe it will drop in price, I'm going to go ahead and set up this strategy. The first thing you need to do, of course, is choose an expiration date. Now, since I'm short-term bearish, I'm bearish, let's say, in the next coming week. I'm just going to leave it with July 2nd here. So that's okay. Now, the next thing we're going to do here is going to involve 4 different contracts, 4 different strike prices, all with the same expiration date. And this will involve both calls and puts. But we're going to start with calls here. So here's the first thing you would do. You're going to choose a price above the current share price. So the share price is 28.10. So we're going to deal with these options up here first. So we're going to choose a price that we believe the stock will definitely not go above by on the expiration date. Absolutely will not go above by. So let's say with Carnival, I absolutely do not think it will be above 28.50 by July 2nd. Right? Because again, I should be, modestly bearish on Carnival. So let's say I don't think at all this will be above 28.50 by the expiration date. So the first thing I'm going to do is I'm going to go over here to sell, and I'm going to sell a call at that strike, or as close to that, a strike price with that price as possible. So the 28.50, I'm going to sell this call. Now remember, when you sell an option, you receive a premium. The premium you receive is found under the price, which is right here. So I'm going to receive 42 cents per share for selling this call. Each contract controls 100 shares. I would receive $42 for selling this call, the 28.50 strike. Now what I'm going to do is I'm going to go back up here, and I'm going to switch over to buy. So now we're going to buy a call, and we're going to buy a call up here, so above the strike of the call that we just sold. And I'm just going to go up one strike here. So I'm going to go to the $29 strike, and I'm going to go ahead and buy this call. Now for buying this call, I'm going to get $28. I'm going to have to pay now, right? I'm going to have to pay $28 to buy this call option. Now, ultimately, just these two alone is a call credit spread, which I'm sure you're all familiar with. So if you call credit spread, ultimately you receive a credit. I'm going to receive $14 if I were to enter this call credit spread. Now, the problem with this is that if we take a look down here, our max profit is $15. Our max loss is $35. You're risking $35 to make $15. So your risk is more than double what your max profit can potentially be. It's not really a great risk to reward ratio in my opinion. And so what we can do here, especially if we're bearish on the stock and we're very confident this stock is going to drop in price, what we can do is use the credit that we're receiving from this play, right? From this call credit spread, which is $14. Use this money to finance another play. And we're going to see how that changes our risk to reward. So now what we would do is we'd switch over to puts. Okay, we're going to switch over to puts. And what we're going to do is we're going to use this credit to finance another play. So what I'm going to do is I'm going to come back down here. Now I'm going to go to the contracts that are below the current share price. So current share price 28.10. I'm going to go and deal with these contracts down here, and these are going to be put options here. So here's what we do. So ultimately, you're going to want to determine what price you really do think the stock will go under by the expiration date. So since I'm short-term bearish on Carnival, I should be thinking that it's going to drop in price from where it's currently at. And I want to determine what price I do think it will be under by on that expiration date. So by July 2nd, let's say I think Carnival will fall to, let's say, $27 or below. Okay. So then what I want to do is I'm going to go over here to sell, and I'm going to sell a put right there. I'm going to sell a put at the $27 strike because, again, I think that by July 2nd, Carnival will be either at 27 or under that price. So now that I sold this put, I'm going to receive another $18 in premium. So now we can see with this custom play so far, we have $32 in credit. We're receiving a credit of $32. Now here's what we're going to do with that $32. We're going to switch over here to buy. We're going to buy a put now. We're going to buy a put that's where the strike is higher than the strike of the put we just sold, but the contract should still be under the share price, right? So I'd have to buy either this one or this one right here. However, we want to use the credit that we're receiving to buy this put. So I'm not going to buy this put because it cost me $50. I only have $32. But I can definitely buy this put because it's basically almost the same price as the credit I'm receiving. So I'd go ahead and buy this put. So now for this play here, 4 different options, 4 different strikes, I'm still getting a $2 credit. And if we take a look at our profit and loss chart, notice that our max profit is now $52, right? Remember, for just this call credit spread that we were setting up, our max profit was only $15. Now with what we just did, by using the credit we're receiving here to finance another play, our max profit has jumped up to $52. And take a look at the max loss. The max loss is 48, and before it was 35. So that barely went up, especially when you compare it to the profit. So now, in my opinion, risk to reward ratio here is a lot better. In fact, your max profit now is higher than your max loss. Over here, your max loss was more than double your max profit. And take a look at the break evens, 28.65 and 28.52. That has barely changed. Okay, so ultimately this is called the double bear spread or the bear spread spread. Very interesting strategy, really great bearish strategy here. And so let's quickly determine our max loss and max profit because you can quickly calculate that without needing any special tools. Our max loss, you can figure that out. Again, that went from being $35 to only $48, so it barely went up. And the way to calculate that is you take the highest call strike, which is 29. You subtract the low call strike, which is 28.50. So 29 minus 28.50, 0.5, multiply that by 100, you get 50. And then depending on whether you paid or you're paying a debit or you're receiving a credit, you would add the premium paid. Or since we're receiving a credit here, we would subtract the credit received. So 50 minus 2 is 48. And that is our max loss. To calculate your max profit, which again, it went from being only $15 with just a regular call credit spread to now $52 here. Your max profit, to figure that out, again, you just take the high call strike, the highest call strike, which is 29, minus the lower call strike, 28.50, times 100, that's 50. And then again, depending on whether you're paying a debit here or receiving a credit, you would subtract the premium paid or add the credit received. So since we're getting a credit, we would add $2 to that. So 50 plus 2 is $52. That's our max profit. Now let's go over to the options or to option strat. A great tool again to visually see what this trade will look like, right? It's always important to know what your reward, what your risk is, what your profit and gains or losses will be depending on what the price of the stock is, depending on what date it is. So we can go under build, and let's just start with the bear call spread, right? The bear call spread. So remember, that's what we started with. This right here, call credit spread, is a bear call spread. And so let's start off with this one. So let's go back to the to July 2nd, because that's the expiration date we chose. We're already on CCL here. So remember, we started by selling the call at the 28.50. This down here represents selling a call. So we'll slide that over to 28.50. And then we bought a call at the $29 strike. So the option up here represents buying a call. So we'll slide that over to 29, right? So again, for this, we were getting a credit of 14, but our max loss was $36, very close to what we saw. Now then, again, we're going to use the credit to finance another play. So we entered basically a bear put spread. So I can add an option here. So we started by selling our put. We sold the put at the $27 strike, which is right there. And then I'll add the other option, which was buying a put, and we bought the put at the $27.50 strike. And so this is what it looks like, right? Net credit $2, so we're still getting a credit. Max loss of 48, but max profit of $52. So our profit is higher than our max loss here. And so let's take a look at what this would look like then. So again, you can kind of mess around here with the chart range if you want to see more, you want to see less. So let's just go right here, I'd say. So ultimately, by the expiration, what do you want to happen? Ideally, you want the stock to be under the strike of the put that you sold, right? That 27 strike put, because if it's at 27 or under, we make $52. Let me actually switch this to graph because it's probably easier to look at it here. So this is what it looks like on the expiration date. So again, ideally, we want it to be at $27, as you can see here, or under, to make our max profit of $52. Now, if it's, at $27.50, which is the strike of the put we bought, or all the way to, 27, that's where we're kind of, in the range of $2 to $52. Now, if it's under, as long as it's under the strike, right, the strike of the call that we sold at $28.50, we'd still make a profit. We'd still make $2 here, as you can see. Anywhere from $28.50 to basically, $27.50, we'd make $2. So we're making a premium there. Now, what we don't want to happen is for the stock to go above the strike, the highest strike, the strike of the call that we bought, or above, right? Because that's where we lose our max money here, which again is $48, right? And then between $28.50 and $29, you're going to lose some of your money. So ultimately, again, ideally, you want the stock to go under the strike of the put that you sold, 27 in this scenario here. And again, you can look at some other things here if you'd like. You can change implied volatility as well, a couple of other things. So again, this is very important to definitely always, come here and check out your trade before you enter it so that you can, really understand where you're going to profit, where you can potentially lose money, things like that. Now, a couple of other things to consider here, guys. Commission fees, number one. Robinhood doesn't have any commission fees, so we don't have to worry about this, but there are some brokers that have commission fees. Commission fees may be a lot. We are opening and closing 4 different contracts here, so that could eat away at your profit. So make sure you always understand what your commission fees are, depending on what broker you're on. The other thing, of course, is risk of early assignment. We are selling a put, we are selling a call. There is risk of assignment anytime you sell an option. Early assignment risk is generally going to be related to dividends and ex-dividend date. So if you're doing this on a stock that has a dividend, or if you're selling an option on any stock that has a dividend, you should always check for the ex-dividend date. I usually avoid selling options that expire on that week that the ex-dividend date lies on. If you are going to sell options that expire on the week of the ex-dividend, I would definitely close out my options 2 days prior to the ex-dividend date to avoid early assignment risk, guys. And so again, ultimately, this is basically combining a bear call spread using the credit from a bear call spread to then buy a bear put spread here. So that's why it's called a double bear spread. So if you have any questions, feel free to leave it in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.